Alright, we got the recorder going, and before we start to look at the swing plays for today, there were some questions on how the signals go out and what they are, what we're looking at. And I know that there's a lot of stuff flying around in the first 45 minutes of the day. That is not going to change. That's the way that trade goes. People are active in the first hour, let's say, unless there's something crazier. I mean, the market has died down now. It was quite active for the first half hour, 45 minutes, and that's when your best chances, not necessarily for a trade, but for a signal that has a high probability of success and a high probability of increased profitability. You can find things to do in the middle of the day, but it is, you're scalping pennies at that point, usually, unless something from the outside markets does something, press releases, that sort of thing, or a random tweet in the world that we live in. Okay, so in the morning, in the early morning, we are looking at primarily three different methodologies. We have here, and all of that I can't keep on the screen because we need the real estate. This one is called the squeeze. Some people call it the TTM squeeze. What it does is it measures the premise of the whole thing is that stocks tend to move in a relatively narrow range and then break out. So they don't move. I think the statistics that I've heard thrown around, they don't move 80% of the time, but the 20% of the time they do move, you can usually catch that. And so what it does is it takes two measures of volatility, and this is all written up on the campus, so you can get the actual math behind it, but it has to do between the relationships of the Keltner channels and the Bollinger Bands. And essentially what that does is when the Bollinger Bands are inside the Keltner channels, you are looking at a period of consolidation. Think about it as a spring coiling up. What you'll see with that, and this is what we're looking at here, with this squeeze, is that's going to be denoted by the red dots. That means that we are in a consolidation period. Once we go from red to green, that means that we have a squeeze breakout. What you'll see there is that's when this happens, for this dot from red to green, that'll show up as a 1. So let's take a look at a real example in Alcoa. Okay, we're seeing a breakout. Okay, it's done under no volume though. So there's a couple things that have to happen. Just because we get a breakout signal does not mean that we automatically just run and play it. One thing that you want to do in the case of a long or squeeze breakout to the upside, a bullish breakout. All right, so we're going to want to watch TDU on Tango Echo. This histogram is a measure of momentum. So what you want to see in the case of bullish, you want to see momentum on this histogram is this teal color. To the downside, you want to see it, we don't have an example of the breakout downside, but you want to see it going into a red. So if you do get a breakout that goes into a dark blue histogram or into a yellow histogram, that's a no-go for me. I also like to confirm these moves, especially outside the early part of the day, as I want this to be done, and even in the early part of the day, I want this to be done in relative positive volume. What this is, this histogram down here is a measure of volume, taking this slice of time, and actually it's taking this 15 minutes of volume, and it's comparing it to the average of the same slice of time over the last 20 days. So what I'm looking at is, let's just say here we are right now, it is 9:36, so at night. So we're looking at the 9:35 to 9:40 bar, or the 9:35 to 9:50 bar if we're looking at the 15 minutes. And it's comparing that volume over the same time of day over the last 20 periods. So when you get these histograms above the zero line, that means that not only is something happening, but it's happening under more than usual volume. And Roseanne, I will show you where you can get this set up in Thinkorswim. I don't know how to get it in other platforms, but if you're running Thinkorswim, you can get all of these, even the ones that we've developed here. You're going to have to do a little bit of copying and pasting of some coding, but that's what that is. Okay, so that's the general premise of the squeeze breakouts. Right now we have no squeeze breakouts, which is a function of the market, nothing we can do about it. Second one we're looking at, those of you that are in Biotech Blitz or spent time with Mike when Mike Patton was running the short-term option, you're going to be very familiar with this. What this is this is a measure. This is giving us a measure of price momentum and comparing it to volume of for example, in NVIDIA. If NVIDIA trades 1 million contracts a day, we've already, it's 9:40 in the morning, we've already traded 61% of that normal daily volume. That means that stuff is happening. So at least it's happening over the aggregate part of the day, not necessarily right now. This is the one where, so in NVIDIA, from a price relative price movement, the first thing that you have to do is you have to have a breakout above or below these purple lines, which are indicative of a 5-day high or 5-day low being breached. So having this type of setup back into this range means that this is not a valid application of this methodology. Okay? But let's see. We know that here's an example of one that did. Okay, here's the 5-day high and low in American Steel. We have an open below, we've made new 5-day lows, and then it extends. This yellow line is what we call the initial balance. That is the first this is a measure of the first 5 minutes, of volume. So this is, so trading from here to here is called the initial balance, and that's the prices that traded in the first bar. After that is defined, then it defines what I think Mike calls them category 1, 2, 3, and 5. I call them DEFCON 1, 2, 3, and 5. They're the same thing. But what this does is this takes into consideration that gap move down to the initial balance, and that says, okay, that is the defined trading range for today. And so it takes that same range and it moves down here for the first stage, here for the second stage, here for the third stage, and if it gets to stage 3, it keeps going. We're not even looking at stage 4. We're targeting stage 5 because something major is happening. Yeah, Michael, we've been trying to figure that out. There's something going on with Thinkorswim. NAN means not a number, which means that there's something that either is incorrect in our code or that Thinkorswim is not processing correctly. But that's what NAN means. But you can still click on it. And this, but you know, so I don't know why it's throwing that number. It throws that number in this one too. And we've been trying to figure out, Mike thought he had it figured out. We did a little programming this morning, and we thought we had it fixed. It's not fixed, or at least not completely fixed. Seems a little bit better than normal, but we'll see. This would not be a valid application of the relative price movement. Why? Because we're still within that 5-day high or low. Pardon me. Yeah, it's annoying, Michael. Don't get me wrong. We'll talk about that too, Thomas. Pardon me. Okay, so that's what this is. And what you're looking for is you're looking for this indice of approximately 40 to 50 or higher. Obviously, the larger this number, the better chance that this is going to work. X is going to work. When we did our trade, when we did our first signal at X, this was not sitting at 220. I believe this was sitting somewhere in the 60s. But as more and more volume flows in here,
we do have a target.
Apple, we were looking at what's happened with Apple. It continued to go higher.
Many of you are looking at the chart.
I had a good idea. I thought that we would get in here, and then it just kind of shot up on us, and I was like, well, I don't want to take it, almost to DEFCON 2, and then have to go to DEFCON 3. In hindsight, I should have, but we didn't. Last day trading application that we have is the gap, which what I'm looking for is we are not in ALXAN. The only thing that we have is on is Amgen, Richard.
Most likely that's where we're going to run into.
So and I'm going to break these into two different methodologies, day trading and swing trading. But what I'm looking for here is I'm looking for gaps. And everybody understand what a gap is? Gap is basically when you have in this case, a 1.5 percentage move up or down from yesterday's close to today's open. And Richard, if you need any help on managing ALXN, let me know. Because Mike N is in that, and I didn't see if he got a fill in that, but that thing should be trading anywhere from a nickel to a dime. Sold it at 40, so that's up to you if you want to hold it for an extra day and take in the whole premium, or if you want to take off the risk. But it moved down 3% plus today. Okay, so anyhow, so I'm looking at
45.
Yep, that sounds right, Mike. I don't think anybody's gonna sell it to you for 2 cents. Not at least not today. Especially because it moved 3% plus today. Okay, so getting back to what this is with the gap is I'm looking for 1.5% moves overnight. Yesterday's close to today's open. And because what the thought is here, and so this is telling me we opened up with a gap of Halliburton, 1.5% down. Okay, see the gap here. Here's where we closed yesterday. Here's where we opened today. That's your gap. To the downside, see, I'm still getting some Tesla. They had earnings. They moved up. Obviously, that's a gap. Yesterday's close to today's open. It's actually continued higher. So then, what do we do with that? What I'm looking for is a gap retracement, like we did in everything's rolling together here. JD. So what you're looking at, and again, this is all, and remember, JD did not work today, but what you're looking for is I'm looking for rejection. So if we have this big gap move down, and actually let's look at Pfizer. That was an actual good. Okay, in Pfizer, we had this move down because of the dividend, and what happened was, you want to concentrate on I'm going to give ourselves a little bit more room to see this thing. You're looking at the first two bars, and what you're looking for is, and it's a little bit esoteric, but I'm looking for bars that are exhibiting behavior that doesn't look, in this case, really, really bearish. If we had a gap down, and then we had another gap down, then that's kind of, you can definitely look at it.
84.53 is the new high for the year.
But what you're looking for is, and here's a perfect example. We gap down, we reject these lows, we close on nearly on the high here, and this guy just kind of hang out. So then what you're looking for is the high of these two bars, which is here. The high here was at 39.87. As soon as we tick above 39.87, that's your signal to get long, and that's what we did.
I already did it before. PKI just killed. No, it's fine.
So that's an example of the gap down, gap fill. And so then where are we targeting? Well, you can gap. We can look at a 1/3 of the gap fill, which is what we targeted, which was the 40 line. I think 40.05 is the half gap, or you can target the whole gap. Obviously, you're going to have bigger gains if you target a full gap fill, but it's going to happen less often. So we've been targeting the 1/3 gap fill, and then just saying, hey, listen, I'm seeing continued movement to the upside, but that's fine.
You're 30 seconds.
I'm recording. What do you need?
My godmother asked yesterday.
Hang on, I gotta turn this off.